From the trading desk of dailyforex.com, this is Christopher Lewis looking at the upcoming non-farm payroll session, January 4th, in the euro-dollar pair. Interesting chart. If you watched yesterday's video, you know that I thought 130.150 was pretty significant support, and if we got below that, it would validate this shooting star that broke down, and that's exactly what we got. You'd also know that 131 was where I thought that this zone might end. I didn't think it was a line. Most of the time when you get this well-defined support or resistance, it's not just a few pips. It's more of a thick line is a good way to think of it. So anyways, either way, we broke that. And you can also draw a little bit of a trend line, and we broke that too. So there's a lot of different reasons to think that this is not only a bearish day, but this is an actual bearish sell signal. With all this being said, we now find ourselves heading into non-farm payroll. And it was interesting because on Thursday the minutes came out from the Federal Reserve, and it leads one to believe that more of the members have expressed their dissatisfaction with the idea of quantitative easing. Quite frankly, it just seems to be losing its effectiveness, and as a result, it looks like, at least some of them are suggesting, that they may want to be out of that game by the end of this year. If that's the case, then the dollar will have to gain as interest rates will rise in the bond markets. When you have the Federal Reserve stepping down the bond markets, that is a very bullish sign for the U.S. dollar, as money tends to flow where the yields are higher. Now, that is neither here nor there at this point in time. That was just the reaction to this potential news. And, you know, a lot of things can happen between now and then. But with this non-farm payroll, this sets it up as a very interesting announcement. So we may have a situation where this thing is born to fail no matter what happens. And what I mean by that is, if we get a bad jobs number, that's a risk-off move, and we should see follow-through. We should see it breaking down. And that's typical. That's what one would expect. However, if we get a strong number, we may see a fall as well. And the reason is this may lead people to believe that the Federal Reserve is just that much closer to normalizing rates. And if that's the case, then more money will be heading to the United States. There is the possibility that we rise, though. But if that's the case, I fully expect this area up here to be resistive. So any move up there, I'm actually looking at, if we get this tomorrow, we get a nice sharp spike tomorrow, I'm looking at selling it off. I think it will roll over at that point. So really, I can find three scenarios here where this pair looks like it's going lower. The question then becomes, well, how would you get to the point where you'd want to buy? And I really think we need to clear 133 at this point. That area has proven to be extraordinarily resistive, and there should be nothing but resistance all the way up there. So having said that, it's likely that I will be selling the euro-dollar pair sometime tomorrow. We'll just have to see how this plays out, but I can see a lot of different scenarios, and really I don't see one that has this pair going higher. And even if it does, I think once we get up to this area, we really would struggle. So with all that being said, it does look like we have some continuation coming for the euro-dollar sell-off.